Well, greetings, my beloved clients and friends. We have an important market update today. Today is May 17th, I believe, May 18th. And there's been this dramatic shift in the market, and I want to talk about that because it's very important for our strategy going forward. So, the market is not a monolith. Right? People ask, well, what do you think about the market? Well, it's not a monolith. There's different segments of the market, and let me talk about the four segments that I'm interested in right now. On one end is the innovation companies, the companies that have potential for high future growth out into the future. They might not be profitable yet, but they're innovating and they're on the cutting edge of technological advancements and what the future could be like, right? And those companies had an amazing run during the COVID era, 2000, and they kind of peaked early in 2020, and they peaked very early in 2021, about January, February timeframe, about February of 2021. And you say, well, what index are you talking about? There's really no index, and I guess as a proxy for an index, we could talk about the ARK Innovation Fund run by Cathie Wood, and she said, you know, the companies I invested in are not in any index. And so she's kind of a proxy for that index. And she had a phenomenal run in 2000, but she peaked early in 2021 at about $150 a share. And that fund bottomed on May 12th at $35 a share, almost an 80% drop from top to bottom. Okay, and those type of companies, that high future growth, just got decimated. A lot of those companies are down 70, 80, 90%, probably about 80 on average, okay? But I'm telling you, I'm calling it, they bottomed on May 12th. Last week, they bottomed last Thursday, May 12th, and a lot of those companies are up 30, 40, 50% in the last week, okay? So that's one segment of the market that have been getting a lot of headlines for how badly they have performed in the last year, since January and especially since November. And then you go one step over, I guess you could say more conservative, would be big tech. The NASDAQ would be a proxy for that. Big tech like Amazon, Apple, Google, Facebook, companies like that. And they peaked in November, so they peaked later, right? And they've come way down from November. I don't believe they've bottomed yet, but they're a lot cheaper than they were in November, okay? And then you have the broad market, the S&P 500, which is a broad swath of the US economy, the biggest companies in there. And they actually, well, the NASDAQ started fading in 21, and the S&P actually did better. And you know, the NASDAQ peaked in November, and then the S&P kind of held its own until about January. So they peaked later, and they're starting, and they've come down, but again, they're nowhere near done to coming down, I don't think. They're next. And they started coming down, but they're not done. And then the fourth element would be the Dow, right? The big industrials, the big old school, capital intensive, labor intensive, debt intensive type of companies. And they've held up the best, and they're starting to take a hit. So, for example, Target just got taken to the woodshed yesterday. They were down 25%. So, I mean, Target is not an innovation company. They're not a tech company. They're just a brick and mortar company that employs a lot of labor. They have a lot of retail space. They sell goods that they don't manufacture, that they got to buy, and that needs to move from different parts of the world to get to their store, right? So they have high transportation costs. They have high labor costs. They have high transportation costs, and they use leverage. So they have they have financing costs. So, and those three big costs have gone up dramatically. There's not been an official raising of the minimum wage to $15, but there's been talk, and a lot of leading companies have said, okay, we're gonna self-impose a minimum wage. And I think I walked into Target and it says now hiring starting at $15.50, something like that. So, and they used to pay like $10 an hour was their starting. So you could say they had a 50% increase in their labor costs. Transportation, moving goods and services to the final destination of their store. And then also they deliver, so that's more transportation costs all the way to your house. Transportation costs have doubled, right? Diesel fuel went from $3 to $6. That's a double. And so that's affecting Target and those type of companies. Plus, financing costs are going up. The cost to borrow money has gone up and will continue to go up. So companies that have those type of costs built in to their capital structure are gonna start being challenged. And those innovation companies really don't have those type of costs. They don't have debt, they don't have transportation issues, and so they've already been beaten. So this market looks a lot like the 2000 bear market, which they called the tech bubble. You know, there was this massive run up of tech companies, .com companies, and in the 90s, and it peaked in March of 2000. And the the growthiest .com type of companies are the ones that got hit the hardest and first. Hardest, fastest, and first, right? The poster child, you could say, was the Munder Net Fund, and it was all these internet companies, right? And it was down like 90% starting from March when it peaked, and then in about a year after that. Now, interestingly, in the year 2000, the tech companies got decimated, but the S&P and the Dow were still up. Kind of like what we could say with 2021. It looked a lot like 2021, where the tech, that high innovation company got decimated, but the S&P and the Dow were still up, right? They didn't peak until January of this year. And then 2001, the second year of that tech bubble, then the S&P got hit, and then the third year, finally value got hit. So a guy like Warren Buffett, you could call him a poster child for value, he did really poorly towards the end of the 90s, 98 and 99. And he was even on the cover, and they said, has Warren Buffett lost his touch, of one of the big magazines. I don't remember which one it was. Because he was really underperforming tech in 98 and especially 99. But guess what happened? When 2000, when tech got crushed, he did fine. He was up. 2001, he was also up. And then finally, the bear came for him in 2002. So the bear kind of goes, he starts feasting on the most aggressive part of the market, and then once he's left no meat on the bone of that one, he goes to the next one and the next one and the next one. And I think that's what's happening and will happen in this current pullback. Like I said, the innovation peaked in February of 21, NASDAQ peaked in November of 21, and S&P and Dow peaked in January of 22. So when we see the market coming down, and I use that word, the market, loosely, because they're not all coming down together, and they're not all going to come back up together. Where do you hide? Where is safety? And it's very, very counterintuitive, because intuitively you would want to run to safety, to something that has not been decimated yet, like to a greener pasture, right? Let's hide there, it's safe. The bear has not come there yet. But guess what? That's where he's going next. So I'm going to use a somewhat gruesome analogy. Imagine you were in Poland in World War II, and the Nazis were coming for you, And you say, well, where should I hide? Should you hide where they have not come yet? And I'm gonna make a suggestion that perhaps the safest place to hide, imagine a mass grave, and there was just the day or two before, there was, they lined people up in front of it, and there was a firing squad, and they all fell into this mass grave. And so now it's just a hole in the ground full of dead bodies. It's possible that's the safest place to hide, right? And if we call innovation that part of the market that's been down 80%, it looks like that. A mass grave. It's possibly the safest place to hide. And indeed, in the last week, it's up about 30-40%. Okay, because the bear is done there. He's eaten that down to the bone. He's moving on to his next meal, and he had already started chewing on NASDAQ. So I think NASDAQ still has a little ways to go, but he's coming for the Targets of this world, the Costco's, because there's still meat on those bones. So you want intuitively, let's move to those safer companies that haven't gotten beaten up yet. But what has happened, and it is a good chance it will happen, that you got beat up in innovation, so you moved a little bit more conservative, and then you got beat up there and you moved a little bit more conservative, and you got beat up there, and the bear followed you every place you went, and you had 2 years of pain. So think counterintuitively, and don't go towards the thing that hasn't gotten eaten yet, because he's coming for it, and go towards that thing that's already been eaten. Okay, so you might see some shifts in the portfolio, and you're like, why are you buying that thing that's been decimated? Why don't you stay in the safe one that you've actually still held up pretty good in? That's why, because the bear already came for that one, and he's done there, and he's probably heading to that other one next. Okay, so it's gonna feel very counterintuitive, but I'm seeing the shift on the market. And if you look at May 12th, there was momentum in that innovation space, negative momentum going down and bottoming out ugly on May 12th, and in the last week it's bounced back incredibly. Okay, so I think that area is largely done, and maybe we could pick through the scraps and buy something good cheap there, and be very wary of that company that, like, I want to pat myself on the back and say, wow, this one's held up pretty good, I've done pretty good on this one, and try to consider that safe. Maybe it's not safe. Maybe the bear is coming for that next. Okay, so this is an important strategy video, so you can understand what we're doing and why we're doing it, and you can't just say, how's the market doing? Because the market is really these 4 segments, and you look at, wow, the market was pretty bad. Maybe we did bad too. And that's not necessarily the case. Like I said, the market, if you will, the headline, if you look at the Dow and the S&P, they've been just taking the woodshed in this last week. But there's innovation, and nobody's talking about it, that's up 30-40% because it had already done getting its beating. Okay, so just something to think about. We got a lot of work to do to navigate through this. We got to be nimble. Hope you guys have a great day.